All right, family, we're going to go ahead and get started with today's topic of celebrating Financial Literacy Month. We're going to be talking about Life Insurance Basics 101. So we have a few participants today. And again, like always on our platform, it's engaging. And so you'll be encouraged to share your feedback, provide your expertise, and the topic. So I'm going to go ahead and share my screen. Can you all see my screen?
Yes.
Yeah.
All right, perfect. Right. Move this out the way. Okay, so let's see. All right, so today's topic is about life insurance basic. Life Insurance 101. I have a question for you all. How many of you all knew that life insurance did more than provide death benefits? Well, if you're anything like me, I wasn't aware. And I recently found out all the things that life insurance does. So today we're going to talk about the 4 functions of life insurance and some of the benefits, and answer any questions you have, and encourage you to look at your life insurance to see and make some comparisons. Maybe time for an upgrade. You'll have to decide. So one of the first functions of life insurance, as you can see here, it says protection. So yes, life insurance is to protect your income, providing your family with the necessary income in the event, the untimely event of your loss. So I want you to think about that. How much do you need then? If you're the breadwinner of your family, how much life insurance should you actually have to make sure that your family is taken care of? I'd like you guys to think about that question and ask yourself, do I have proper protection? Is the right protection in place? You know, as humans, some of our basic instincts is to protect ourselves. You know, we had a discussion the other day about, guns and why everybody's having guns these days. Well, that's an instinct of humans to protect themselves. And so hence life insurance, we put that in place to protect ourselves, to protect our income, and to leave something for our families. But here you see this thing called living benefits. Well, what is living benefits? That's something new. Did you all know that life insurance included living benefits? Does your policy have living benefits? Living benefits would be something like a chronic or critical or terminal illness. I want you to think about that for a minute. And we're going to go to the next question or the next slide that deals with how much life insurance should I have? Well, here is known as the dying method. And when you sit down with me or any person and you're looking at to determine how much life insurance you need, there's a formula, right? Have you all ever seen this before? Have I gone through this dying method before? Anybody? Well, in the industry, this is how we determine how much you need. So I want you to think about your dime as we're going through the slides. And DIME, again, is an acronym. It stands for debt, income, mortgage, and education. These are some of the things that we want to replace in the event of a loss and reasons why we get life insurance. So debt, yes, we want to make sure that when we leave this planet Earth, that we leave a legacy and not just debt for our family. So we want to take into account how much debt we have when we're thinking about how much life insurance we need. Okay, and we'll talk about the different types of debt and the different types of life insurance, so you'll see. The next thing we think about when we're trying to figure out if we have the proper life insurance is, replacing our income. And in the industry, we say for the breadwinner to think about replacing their income for 10 years. Like it'll take your family 10 years to recover from the loss if you're the breadwinner. 10 years to live the life that you've left them with to recover. So we ask you to take your income and multiply that by 10. And that figure is how much in income you want to make sure you have covered in your life insurance policy. The other thing we talk about is mortgage. You guys have mortgage? Anybody have mortgage here? All right. You can add something. You can put something in the chat. You can add a little caption, a little reflection. Raise your hand if you have mortgage. Well, when you think about life insurance, you want to think about having mortgage protection, having enough mortgage protection to cover, having enough in your life insurance policy to cover your mortgage. And then lastly, we look at education. If you have children, you might want to plan for your children's education. You also might want to think, some people don't believe in education these days. They're not interested in sending their kids to university because of the debt. They want their children to go straight to work. So you might want to plan for a wedding. You might be planning for a big event that you can put away and save and have your life insurance policy available to use when that big event comes, again, like a wedding. So these figures together give you the total of how much coverage you need in proper insurance. Anybody do they die method? Anybody got their numbers? Don't be shy. Okay, if you need help getting your number, I can help you with that too. But this is how we determine proper coverage. How much insurance does a person need? Now, here, back to living benefits, back to that first function of life insurance. We want to know what life insurance does. So it provides a death benefit. And nowadays, with the upgraded policies, they also have what's called living benefits. Any of you guys heard of living benefits? Okay. So,
Yeah.
yes, you've heard of living benefits? Great. Thank you, Linda. So here you'll see that, again, living benefits is to support you and be there for you if you have a chronic or critical or terminal illness. And illness is the #1 cause of bankruptcy. Were you aware of that? Were you aware that if you get sick, your health benefits will pay the doctor and pay the doctor's bills, but who's paying your bills? And if you notice in the first picture here, when someone gets sick with one of these chronic, critical, or terminal illnesses, their income drops because they can't work, and their expenses go up because they're not able to work, especially if you're surviving, if you're a stroke survivor or a heart attack survivor, or you have, Alzheimer's or something like that, you may not be able to work. And so your income drops and your expenses go up. Now, if you had living benefits, as in the other picture shows, the living benefits, you'll be able to pay for your bills, your personal bills. Remember, your medical insurance covers the hospital, it covers the doctor. But who's covering you? Who's paying your mortgage? Who's paying for your self bill? Who's paying for your groceries, for your cost of living? Now, if you had living benefits, you would be able to get your death benefit accelerated to you. Sometimes, they're up to 70–80% of the death benefit gets accelerated to you if you're diagnosed with a chronic, critical, or terminal illness. So keep that in mind, okay? And let's make sure that you have the most updated plans. And we can tell there's 4 people on the call today, thank you so much, including myself. It says that 1 in 4 of us will have either Alzheimer's, a stroke, or some kind of debilitating chronic, critical, or terminal illness in our lifetime, and you can see the chart yourself. The figures are pretty high. 5.8 million Americans with Alzheimer's, 7 million have a stroke, 76.7, they live, they survive, and now they have to still pay their cost of living. So I want to think how many of these individuals had living benefits when they were diagnosed that their insurance sent them a nice check that they can live on while they were recovering and healing. Think about that. Think about your family. Think about your friends. Think about yourself. Today's conversation is to get us to think about where we are and to make some changes. Any questions about that so far? Okay, now here are all 4 of the functions of life insurance. We talked about the protection, we talked about the death benefit and the living benefits. But did you know that life insurance allowed you to accumulate cash, tax deferred, also allows you to have tax-free income in retirement? Were you aware of that? And in the event of your death, your family gets tax-free death benefit. They don't have to pay taxes on a life insurance beneficiary. So these are the 4 functions of life insurance. Now we're going to get into the types. We talked about the functions. Now we're going to talk about the types. There are 2 general types of life insurance: permanent, which lasts for the rest of your life, and term, temporary. We're going to start with the permanent life insurance first. Now, with permanent life insurance, I want to make sure y'all can see the screen. You pay a premium, and your premium goes into 2 pots. The first pot, it goes into what's called the cost of insurance. Okay, and excuse me for moving this around on y'all. Hopefully it's not too distracting. The cost of insurance, and then your premium pays for cash accumulation. With this cash accumulation, you get tax-free income in retirement. Your plan is designed properly. When you design it to pull the cash out in your retirement, it's tax-free. The death benefit, your beneficiaries get it. It's a tax-free benefit. So they don't have to pay taxes on life insurance. Okay. Now, I mentioned permanent life insurance. Within permanent, you have what's called whole life, which most of us are probably really familiar with. And whole life is fixed. It lasts for the rest of your life. You don't have a lot of flexibility, so you can't adjust the premiums, you can't increase them, you can't lower them. They are what they are when you sign up. And the interest, the rate of return, and the accumulation of cash is 3 to 4%. And that's pretty good, steady, slow, no big waves, steady, slow, right? Now, if you need more flexibility, you want to look into the universal life permanent policies. With the universal, there are 3 types. You have the guarantee universal life, you have the variable universal life, and you have the index universal life. Did you guys know that there were this many types of permanent plans out there? With the universal life, the first one is guaranteed universal life. They call it a GUL. The GUL kind of acts like the whole life. It's fixed. You get about 3 to 4% rate on your cash accumulation. And it's not so much affected by what's going on in the climate. It grows steady and slow, but you don't have a lot of flexibility. So you can't increase. If you get a lump sum of money, you can't add more in. If you are having a bad time, you need to lower your premium, you can't do that. There's no flexibility with the guaranteed universal life. Unlike the variable universal life, it's what it is, it's variable. And depending on the climate, the economic climate, your cash accumulation is affected by that. You see the squiggly lines going up and down and up and down. That's indication of the market. You can earn a lot in your cash accumulation, and you can lose a lot in your cash accumulation. And so with these types of plans, you want to be very mindful. I personally, my license does not allow me to sell those type of plans. I am not into losing money. I'm only into securing people's money and growing money. And with that in note, I want to next go into the index universal life, the IUL. Many of you guys heard of the IUL? The IUL has been around since 1995, this universal life, IUL. And I didn't hear about it personally myself until about maybe 6 years ago, but it's been around for almost 30 years now. Right. And with the IUL, you get the best of both worlds. You get the best because it is with you for the rest of your life. You get the benefit of the growth of the market, but you don't get any of the losses of the market. So with those squiggly lines, the lines are going up and then they floor. The floor is what they would call a cap, or a floor, not a cap. A floor. It can't go lower than that. So as the stock market is going up and down, you see this red line goes beneath the floor, your policies in that cash accumulation will lose money. With the index universal, there is no loss. You go to a floor, which is about 2.5%, 0.25%. And then it goes back up. So again, you get the benefits of the market and growing your cash, but you don't get any of the losses. So if you had the choice out of these options, which one would you be interested in? Would you want a steady growing with no flexibility? Would you want a up and down, affected by the market? Or would you just want like a stair step where you just grow and flat and grow and flat and grow and flat? Kind of indicate in the chat room what you would want. A 1, a 2, or a 3. 1 for the guarantee, 2 for the variable, 3 for the index. Which one do you think works best for your situation? I know for me, when I found out about the index, universal life, I jumped right on it. That was something that I knew that I wanted to secure my money and grow my money. Now, the second type is what they call term or temporary. Now, temporary is just what it says. It's temporary. So it doesn't cover you for your entire life, but they do have years, level premium years. So depending on your goal and what you need, you might get a 30-year, you might get a 20-year, 15 or 10-year. Whatever the term is, at the end of that term, when that period ends, your premium does increase substantially. So this may be good for some partners, business partners, may be good for, if you have a mortgage, you have children and you want to get something to cover and make sure that, that's there until they're maybe 26 and they can take care of themselves. But definitely be mindful with the temporary plans that it is for a term. And at the end of that term, you do have to requalify. So keep that in mind. Look at your policies, pull out your plans, look and see if yours is the temporary plan. Then you want to make sure when that plan term ends, what does that premium look like at the end of that term if you have to renew it? Okay. So any questions so far about the permanent versus the temporary plans? You guys are awesome. So here, this is what our financial industry looks like. And these industries impact our portfolios. They impact our plans, any plans that's accumulating cash. These are the places where your cash is stored. You either have cash in a bank, which provides safety. And of course, we can have a lot of discussions about bank safety, knowing that banks are collapsing around us. But generally speaking, they're safe, right? You have the FDIC to insure your money. Again, more insurance that the banks use to insure your money, to secure your money and make sure they can recover it, right? You have access to it. It's liquidable. You can get to the money at the bank, right? So you don't get a lot of return on money that you have saved in the bank, right? Because it moves fast. It's not a long-term usually investment. So you might get maybe, if you get $1 on a rate of return on your savings in a bank, right? The next place where you can grow money and store your money is in investments. When you have several kinds of investments. Do you all have investments? What type of investments do you have? Real estate, 401ks. These are all investments and they get a rate of return, right? That rate of return is determined by the current climate. So if things are going well, you may get a high rate of return. Things are not going well, well, now you're going to look like that zigzag up and down, up and down, up and down. So you need to think about your portfolio and where you have your money growing. The last place that money can grow is in insurance. And we talked today about insurance. We talked about some of the benefits, and we talked about the different types, right? One of the things that's exciting is you get a tax advantage for your investment. Now, where can you get all three? Get safety, a high rate of return, and tax advantage? Through your life insurance policy. So you want to make sure you're getting your reviews. How many of you guys had your annual reviews yet for your policy? Anybody? Well, just like we go to the doctor and we get our reviews, we want to make sure we're scheduling our annual reviews. So I'm going to go ahead and stop my screen now and open it up for some discussion. It was a lot of information and it kind of went fast. So I want to check with you all to find out, when you look at those three areas, the banks, the investments, and the life insurance, I want to have a discussion with you all in terms of, what does your portfolio look like? What type of experiences are you all having? Are you noticing the market impacting your portfolio? I want to open it up to you all. Any discussion you want to have about the slides, about the concepts that triggered you, that made you say, I wonder about mine.
If I can say just a little bit, this is Linda.
Hey, Linda.
Because hey, because I'm learning about my life insurance now, because I think I have the direction I'm going. But something you mentioned tonight, the investments
Yes.
and real estate. So that's what I've been working on also.
Yes.
So I'm glad that you put that in your that we need to include that in our portfolio.
Yes. You may need to have pieces in all pots, because diversifying means you have your money growing in multiple places. It also means that the timing of taxes, that you understand that some of your portfolio may be tax advantaged, some may be tax now, and some may be tax deferred. That's another conversation. Are you aware? Did you know that your life savings was going to be affected by the market?
Well, I didn't know that before, but I'm glad you put it like that. Your life insurance can be another multiple stream of income, and I've never thought about it like that, but you can.
Yes, with those permanent plans, Linda, those permanent plans, you have with your premium, you pay for a cost of insurance, and you also pay for cash accumulation. So if your premium is, I don't know, say, $250, you might pay, I don't know, $75 in cost of insurance, and then the rest of it will go towards cash accumulation. And that depends on how it's designed. The design of the plan is the key. And understanding the design so that it's a tool that you're using when you need it. Because it's not just a plan, it's a tool. Well, you guys have been so kind to join this call. You're amazing. I appreciate the input. Are there any final closing words before we end our call today?
Hello?
Hey, Brother Mashinda. We can hear you. You want to, oh no, you got to unmute yourself, Brother Mashinda. Well, again, I thank you all for getting on. I look forward to having our one more session for the month of April for Financial Literacy Month. Oh, there you go, Brother Mashinda.
No, I was just thanking you for your presentation. It was very informative. I was just being a good listener. As far as insurance goes, I've taken and had a policy years ago, a whole life. I've even taken out some term life recently, and I've had more than one policy. Actually used some of it, took advantage of the cash value. I was working on some property, and I said, "Wait a minute, I have this policy here." And I have these other. I said, "Don't take much to bury me." And I look at my family, and if something was to happen to me, can without putting a strain on the finances, or putting a strain on things. And so again, of course my wife, she has policies with her job, and I'm included. She's, I think, got one out on me, so we kind of invested in some policies. So, and kind of at the same time, at this point in our life, trying to pretty much reduce a lot of our debt. So like you were talking about in the last podcast, kind of getting that debt down. So when you retire, you'll be able to, sustain your lifestyle, or at least at the same time, have food to eat, lights, gas, to be able to sustain your life, and maybe do a few things. And but I just said, speaking on that insurance though, I was able to utilize some of that. It was a policy I forgot all about, and it had a nice piece of and it said, well, hey, you can take a loan, or you can just it'll just reduce the face of the value. So I said, well, you know what, I'll just reduce it a little bit. I snatched out a certain amount of money, and matter of fact, I looked at it yesterday, and I said, did I cancel that thing? I just didn't remember if I canceled it out. But no, I'm a busy person. But I looked at it, and all they did was they reduced it by a certain amount of money, but I still have that, and that cash value actually bettered my position. I've used that money wisely. So, but anyway, um, other than that, like Sister Linda was talking about real estate, yeah, trying to get some passive income with that. Just trying to not put my eggs in all in one basket, and try to diversify, and so forth. And I'm still learning, and but thank you for your presentation.
Thank you. And you've added so much. I really appreciate everything you said. And yeah, even with the loan on your cash value policy, there is you get access to it without having a tax penalty, as long as your loan is within that threshold. You go over that threshold, then you start having tax penalties. But thank you. Thank you so much. So if there are no other questions, again, I really appreciate you guys getting on. Thank you, Nicole, Mashinda, Linda. Thank you so much for your time this evening. And I'm here for service. So if you haven't had your review, and just like you have your annual review every year by your doctor, if you need to have your policies reviewed, you want to roll over and secure your annuities, if you're just dealing with some resources and you're not sure what to do, ask a sister. I have a big team that I'm part of, and our mission is to help families build, preserve, and protect their legacy. So I thank you so much for your time. And you all have a good evening. Peace and blessings.
Thank you.
Thank you so much for attending. Peace and blessings.
Peace and blessings.
You good night, everybody.